You didn't do anything wrong. You didn't miss a payment. You didn't let the lawn die or skip the gutters. You went to bed in a house worth one number, and you woke up in a house worth $80,000 less. Same walls, same roof, same kitchen you renovated 2 years ago. Nothing about your home physically changed, and yet a chunk of money the size of a brand new luxury car quietly walked out the front door while you were asleep.
The average rate on the popular 30-year fixed loan dropped sharply in the third quarter, but then just kind of hung out between 6.2% and 6.4%.
Today, I'm going to expose exactly how that happened, who actually took it, and why almost nobody warned you it was coming. Because once you see the mechanism, you'll never look at your home's value the same way again. Let me start with the thing nobody explains clearly, because it's the root of everything. Your home's value is not your home. I know that sounds strange, so stay with me. The bricks, the paint, the square footage, the upgrades, all of that matters, but it is not what sets the price. The price is set by something invisible and completely outside your control. The size of the crowd that can afford to buy what you own on the day you decide to sell. That's it. That's the whole machine. Your house is worth exactly what the most motivated, qualified buyer is willing and able to pay for it, and not $1 more.
They were told to do, right? They have that expensive degree, the good job, but they can't get ahead. I do believe that there is some hope on the horizon, but it's going to be a gradual climb out of this. It's not going to.
And here's the part that should make you sit up. That crowd of buyers is not fixed. It grows and shrinks constantly based on forces happening far away from your street. Interest rates set in Washington, insurance decisions made in boardrooms, the behavior of sellers 3 neighborhoods over. None of it shows up on your property. All of it shows up in your price. So when your home loses $80,000, your house didn't change. The crowd did. The pool of people who could afford your home quietly drained. And a smaller pool means a smaller price. This is why the loss feels invisible. You can walk every room of your house and find nothing wrong, because the damage didn't happen inside your walls. It happened inside the market, in places you were never looking. So let me take you to each of those places, one at a time, and show you the specific forces that picked your pocket while you slept.
To heat up here, the average rate on a 30-year fixed mortgage now down to 6.23%. That's down from 6.3% last week, the third straight weekly drop, and the lowest level since about mid-March. Let's also compare that to last year, when rates were substantial.
The first one is the quietest, and it's the most powerful of all. Start with the single biggest thief, the one that operates completely in the dark: mortgage rates. Here's what most homeowners never connect. You don't sell your house to a pile of cash. You sell it to a monthly payment. The vast majority of buyers aren't asking what your home costs. They're asking what it costs per month, because that's the only number their budget actually feels. And that monthly number is controlled almost entirely by the interest rate, not the price. Watch what happens when rates move. Back during the pandemic, mortgage rates fell below 3%. At 3%, a buyer with a normal budget could afford a surprisingly large loan, because the monthly payment on that borrowed money was cheap. That huge, well-funded crowd of buyers is what drove prices to the moon in the first place. But rates didn't stay there. They climbed, and in 2026, the typical 30-year rate has been sitting in the low to mid 6% range. That sounds like a small jump on paper. It is not. When the rate roughly doubles, the monthly payment on the same loan balloons, and the size of the loan a buyer can qualify for shrinks dramatically. So picture the buyer who could have afforded your home 2 years ago. At the lower rate, your house fit their monthly budget. At today's rate, the exact same house blows right past what their payment can handle. They didn't get poorer. The math just turned against them, and they got knocked out of the running for your home entirely. If you want help putting all this into action in your own home, grab our guide, Home Saving Secrets. It's a simple 50-page playbook showing you 5 legal ways to cut your property tax, insurance, PMI, and escrow. The average homeowner saves over $4,000 a year. The link is in the description.
7 or almost knocking on the door of 8% of a couple of years ago. Now, most people are in a mortgage below 5%. They're not going anywhere. But we're starting to see some movement here. By the end of last year, you had about 1 in 5 mortgages in this country were at 6%. So people are giving up on the idea of...
Let me make that real with actual numbers because it's startling when you see it. Take a $400,000 loan. At a 3% rate, the monthly principal and interest comes out to roughly $1,680. Take that same $400,000 at 6.5%, and the payment jumps to around $2,530 a month. That's over $850 more every single month for borrowing the exact same amount of money. Flip it around, and it's even more revealing. The buyer who was comfortable with a roughly $1,700 payment could afford a $400,000 loan at the low rate. At today's rate, that same $1,700 budget only stretches to about a $270,000 loan. The buyer's wallet didn't shrink. Their buying power got amputated by more than $100,000 purely because of the rate. And every one of those buyers who can suddenly afford $100,000 less is a buyer who can no longer reach your asking price. Multiply that one buyer by thousands, and you've quietly deleted a huge slice of the crowd that sets your price. Fewer qualified buyers competing means less upward pressure, and less pressure means your value sinks silently without a single thing changing about your actual house. And here's the cruel twist hiding inside this. The very thing keeping you from selling is the same thing keeping prices stuck.
Prices kept pushing relentlessly higher, so affordability gets worse. In the next era, that story flips, so sales are starting to move higher, but prices capped or maybe down. Incomes are rising faster than prices, and so...
This is what the experts call the lock-in effect, and it's worth understanding because it's quietly reshaping the entire market. Millions of homeowners refinanced or bought when rates were near rock bottom. They're sitting on a 2 or 3% mortgage. To them, selling and buying again at 6% feels insane because they'd be trading a cheap monthly payment for an expensive one on a similar house. So they stay put. They don't list. And while that protects their own payment, it does something strange to the broader market that eventually circles back to bite everyone, including you. Hold that thought, because we're going to come back to what happens when that frozen market finally starts to thaw, and it's not what most people expect. But rates aren't the only thing shrinking your buyer pool.
Due to wildfire risk here in Orinda, their premiums expected to go up 31%.
This is going to really hit hard for a lot of people.
With fire season ramping up, insurance industry expert Carl Sussman on the news that customers on California...
The next force is one I've talked about before, and it's getting worse. Even when a buyer can handle the mortgage, there's a second number that's quietly destroying their budget, and therefore your price, the cost of simply owning the home. Insurance and property taxes. Here's the trap. A lender doesn't just look at your mortgage payment. They look at the full monthly cost, mortgage plus taxes plus insurance, all bundled together into what's called escrow. And across huge swaths of the country, the insurance and tax portion of that bundle has exploded. In the hardest hit states, homeowners insurance has climbed to several times the national average, and property taxes have crept up right alongside it. So even when a buyer finds your home at a price they like, the moment their lender adds in the real cost of insurance and taxes, the total monthly payment balloons past what they can afford, and they're forced to walk. Think about what that does to your price. Every $1,000 a year that insurance and taxes rise is $1,000 a year your buyer can no longer put toward the mortgage. To keep their total payment the same, they have to offer less for the house itself. The carrying cost goes up, so the price they can pay goes down. It's a direct trade, dollar for dollar, and it's happening on streets all over America. Economists have pointed directly at rising insurance and property taxes as a key reason home prices have been sliding in much of the South and Sun Belt.
That insurance rates have been going up and up in recent years, but another type of insurance a lot of people aren't watching as closely, their homeowners insurance. Paul Burns has spent the past few years making sure his home is in tip-top shape.
So you've done a lot of work.
Your home didn't get less valuable. It got more expensive to hold, and that expense came straight out of what anyone's willing to pay you for it. So now you've got two invisible forces working together. Higher rates shrinking who can borrow, and higher carrying costs shrinking what they can offer. And just when that pressure was building, a third thing showed up to make it worse: the competition. For a couple of years, there was almost nothing for sale. Inventory was historically low, partly because of that lock-in effect we just talked about, where nobody wanted to give up their cheap mortgage. When there are 10 buyers chasing every one house, prices scream upward. That was the world that created your peak value. But that started to change. As of early 2026, the number of homes for sale has been climbing back, and the balance of power has shifted toward buyers in much of the country.
Interest rates, then the intrinsic factors, the cost of living, and the complete uncertainty in so many markets. Homeowners insurance, car insurance, and utilities, and medical insurance.
This is likely why more agents reported.
And this is where that frozen, locked-in market I told you to remember starts to thaw. And it plays out in a way most homeowners don't see coming. People assume that as long as everyone clings to their cheap mortgage, supply stays low, and prices stay protected forever. But life doesn't pause for interest rates. People still get divorced, still get job transfers, still have kids, still retire, still pass away. Every month, a certain number of those locked-in owners are forced to sell no matter how much they hate the rate they're walking into. The dam doesn't break all at once, it leaks. And as more of those reluctant sellers trickle onto the market, inventory creeps up, the buyer's leverage grows, and the prices those forced sellers accept become the comps for everyone else. A market frozen by low rates isn't permanently protected. It's just delayed, and the thaw arrives one life event at a time. Listings come down on price month after month. In fact, by the spring of 2026, the country had seen something like 6 straight months where typical list prices were lower than they'd been a year earlier.
21% saw sellers with the advantage. As for prices, 44% said they saw them declining, 38% stable, and just 20% increasing. Now again, all real estate is local, and market fundamentals are therefore different based on location, of course. Still, the
flood of for sale signs you might not have consciously noticed on your drive home is exactly the kind of thing that quietly resets your value, because now that shrinking pool of qualified buyers has more homes to choose from. And when buyers have choices, they stop overpaying. They negotiate. They wait. They lowball. Every extra house on the market is one more competitor pulling demand away from yours and pulling your price down with it. Here's how subtle this is. You don't see your value drop when a neighbor lists their home. You see it drop when their home sits unsold for 90 days and they finally slash the price to move it, because that slashed price becomes the new comparable, the new comp that every appraiser and every buyer's agent uses to value your home next. One desperate seller 3 streets over can quietly redefine what your house is worth, and you'll never get a phone call about it. And it cascades, which is the part that makes it so quietly powerful.
Changing this spring, it is no longer what they talked about as a stuck housing market last year. So if you're hoping to jump in, you're going to do best if you're prepared and understand the current market trends.
The spring housing market is off to a promising start.
The first desperate seller sets a lower comp. The next person who needs to sell now has to price against that lower number, so they list even lower to compete. Their sale becomes the comp. After that, a single panicked transaction becomes 2, becomes 4, and within a few months, an entire neighborhood has repriced downward, each sale dragging the next one with it, like a slow leak nobody can see until the whole tire is flat. Appraisers are required to use recent sales, so even if 90% of your neighbors are perfectly happy holding, the handful who sold low are the ones writing the official story of what your street is worth. Your equity gets defined by the most desperate people on your block, not the most patient ones. And you're sitting at home, having done absolutely nothing, watching a number fall because of choices other people made. Which brings us to the most psychological thief of all, the number in your own head. This one isn't about the market at all. It's about you. And it's the reason an $80,000 loss feels so brutal, even when, In a real sense, it might not be a loss at all. Let me explain. A lot of the markets bleeding value the most right now are the same ones that went absolutely vertical during the pandemic. Places in Florida and Texas like Austin, Tampa, Miami, Orlando, and the Cape Coral region of Florida saw enormous frantic price spikes from 2020 through 2022 as remote workers and investors flooded in.
I think that's the right way to go. Well, think about this. If you're worried about the job losses accelerating and builders are speccing, they're providing the consumer a mortgage rate buy down. If you do a build to order, you can't do a mortgage rate buy down. The timeline to close.
Some of those markets have since posted year-over-year declines in the range of 6%, and in the steepest spots, quarterly median prices have fallen close to 9 or 10%. So if you bought near the top, or if you just watched your Zillow estimate hit some dizzying peak number, that peak is the figure burned into your brain. That's the 80,000 you feel like you lost. But here's the uncomfortable truth. That peak number may have never been real. It was the product of a frenzy, an emergency low interest rate, and a buying panic that could not last. The value didn't get stolen from you. It evaporated because it was partly an illusion to begin with, a price that only existed as long as free money and a stampede of buyers existed. When the music stopped, the price drifted back towards something the fundamentals could actually support. You're not necessarily poorer than you should be. You may just be comparing today's honest number to yesterday's fantasy number and measuring your grief by the gap. That distinction matters more than anything else I'm going to tell you, and it's the key that unlocks what you should actually do about all of this.
For Zillow, revenue up 18% year over year. As you mentioned, mortgages a bright spot, up 56% year over year, and rentals growing 42% year over year. And the environment you asked about, the housing market, relatively flat. Barely any growth in Q1, and we're not seeing.
So let me pull every thread together now, because the real story here is bigger than any single force. Step back and look at what really happened while you were sleeping. No single villain took your $80,000. There was no burglar. Instead, a whole system quietly levied a tax on your home, all at once. Interest rates doubled and shrank the crowd of people who could borrow enough to buy your house. Insurance and property taxes climbed and ate into what the survivors of that crowd could afford to offer. A rising tide of new listings handed those buyers options and the power to negotiate you down. And the comp set on your own street got quietly reset by whichever neighbor was most desperate to sell. Each of those forces is invisible on its own. Stacked together, they're an $80,000 hole, and not one of them required your house to change at all. But here is the single most important thing to understand. The thing that should actually let you breathe. That loss is only real if you sell. Until the day you sign over the deed, that $80,000 is a number on a screen, not money out of your bank account. It's paper. It's an estimate. It is the market's opinion of your home on a bad day, and markets change their opinion constantly. The homeowners who got genuinely hurt in every downturn in history are almost always the ones who were forced to sell at the bottom, or who panicked and sold into the fear. The ones who simply held, kept making their payments, and waited, watched those paper losses quietly heal as the cycle turned. And the cycle does turn. Even now, the data suggests the number of markets losing value is expected to shrink, not grow, as things stabilize. While the loud Sunbelt markets corrected, plenty of quieter markets in the Midwest and Northeast actually gained value over the same stretch. The map is always shifting. So what do you actually do with all this? 3 things, and they're simpler than you'd think. First, stop checking your estimate every day and emotionally bleeding over a number you have no intention of cashing in. Daily price watching on a home you're not selling is pure self-inflicted stress. Second, attack the one part of this you actually control. You can't move interest rates, but you can shop your insurance, appeal your property tax assessment, and cut your real carrying costs, which is the very thing that's been squeezing buyers and quietly dragging values down in the first place. Lowering what it costs to hold your home protects you whether prices rise or fall. And third, if you're not forced to sell, then don't let an invisible, temporary paper number push you into a permanent, real decision. Time is the one tool that turns paper losses back into equity, and it's the one tool a panicked seller throws away. Because here's the lesson underneath all of it. The people who lose money in housing are rarely the ones whose value dipped. Almost everyone's value dips at some point. The people who actually lose are the ones who didn't understand the machine, panicked at a number they didn't understand, and handed a temporary dip to someone else as a permanent gain. Don't be the exit liquidity for someone smarter than you. Understand the machine, control what you can, and let the rest ride. You didn't lose $80,000 while you were sleeping. The market just whispered a lower opinion of your home on one particular day, in one particular season of the cycle. What you do when you wake up and hear that whisper, whether you panic or whether you understand exactly what you're looking at, that's what decides whether the loss ever becomes real. If this changed the way you see your own home's value, do me one quick favor and subscribe to Bricks Market. This is exactly what we do here. Rip the cover off how the housing market really works so you can stay calm, stay smart, and keep your money on the right side of every shift while everyone around you is panicking. Hit that subscribe button, and I'll see you in the next one.